The views expressed on this podcast are those of the participants, not of Reuters News.
The AI apocalypse has claimed its first victim. At least that's what investors appear to think. The share prices of a swathe of high-tech software firms have collapsed this month as the rapidly increasing sophistication of language models like Anthropic's Claude raised the dark possibility that a single company's helpful digital assistant will be able to replace many other tools. Demolishing nearly $1 trillion of market value in 6 days, the list of individual losers includes many former high flyers. Big company automation provider ServiceNow has crashed 30% year to date. Salesforce, the kingpin of inscrutable enterprise software giants, is down 27%, and Photoshop maker Adobe has slumped 20%. It's a grim harbinger of future shocks still to come from the companies building large language models. Alphabet, Amazon.com, Meta Platforms, and Microsoft pledge roughly $700 billion on improving chatbots even further. As bad as that is for the companies at risk, it might be even worse for the buyout shops stuffing them with leverage and for the broader corporate world. What might happen next is the subject of this week's Viewsroom. It's Amy.
And it's Jonathan, and this is the Viewsroom, your weekly podcast exploring the knottiest topics in business and finance. And Amy, this week, it might be hard to dispel visions of a blank-faced Arnold Schwarzenegger hunting humanity's last hope, because corporate America has a Terminator, although its name turns out to be Claude. The recent sell-off kicked something that's been brewing for a while into high gear and seemed to be linked to the debut of some new features for the chatbot, though frankly, honestly, if you look at what's been happening over the past few months, this has been the direction of travel. I think concerns have been brewing for a little while here, especially since the release of Claude Code, which is a kind of helpful interface for doing pair programming with a computer. And when you look at a lot of these companies, these were in large part what was supposed to set America apart from other markets. Like the big story of why US equity markets have done so well over the past few years, because they're full of these really dynamic, kind of, no fear investment case, like risk it all startups in the digital realm that ended up growing up to, immensely impressive growth rates and the promise of kind of future cash flows. And now that's kind of under threat.
Yes, I mean, one thing that I'm sort of curious about, Jonathan, is you are covering this quite a lot over in the US, which is AI and the risk that these stocks are completely inflated, right? The likes of, Anthropic obviously isn't listed yet, but as in the idea that these companies just may not live up to the promise that everyone's so excited about, yet there are these companies that appear to be impacted by them that are, as we've just pointed out, collapsing in terms of shares. So just wondering, what's your thoughts, Jonathan, on how those two things can be true?
It's a very knotty paradox. You're sort of damned if AI works and damned if it doesn't. There's a very, very big leveraged bet, increasingly leveraged bet on making AI work. You have your Blue Owls, your Apollos, your Blackstones putting in a ton of debt to help support these giant companies build out these data centers and kind of cover the earth with chips so that Claude can be even more helpful in the future. And people are worried about that. They're worried about, when are we going to start seeing a productivity boom from this? When are we going to start seeing like the real effect on corporate bottom lines? And then on the other side, you have all of these other companies, which the Blue Owls and the Blackstones and the Apollos, well, maybe less so. Some of those, like, Blue Owl is a bit more towards technology, Apollo much less. But, they're also in the business of financing buyouts of a lot of these companies. So there's sort of risk on both sides of the house, and it's a lot to kind of pick through and untangle. And fortunately, we're joined this week by two folks who are much smarter than the both of us on all of these issues. We have Neil Unmack, Associate Editor in London, covering private credit, among many other things, and Pranav Kiran, who's been surveying the software landscape from Toronto. Neil, Pranav, you are very welcome to the Viewsroom.
Thank you.
Hey, Jonathan.
So let's start with what actually happened here. Is AI actually replacing any of these software companies? Like, do we have, a big cliff edge moment where every Fortune 500 company is suddenly saying like, wow, I'm just going to get Claude to do all this? Because it feels like that's basically like the big implication of what's happening in a lot of these stock collapses, right? Is the sell-off kind of overcooked?
Yeah, so the answer to that question, Jonathan, is that it really depends. And if you look at the market sell-off, it really hit three distinct groups of companies. Firstly, inside of enterprise software, you have a group, which is where the business models are very vulnerable to AI. You think about companies that help clients automate marketing or like, test code and like, perform something like, version control on their tech products. Companies like HubSpot or GitLab, those are really like very vulnerable to AI, things that AI is really good at. So those stocks have been, hit like 60, 70%. And there, I think, the sell-off is like quite justified. Secondly, inside of software itself, you have these other firms like, we mentioned earlier, ServiceNow. These are companies that are actually making AI products and like able to sell them to clients. There, I think, sell-off is like, quite overdone. And finally, the sell-off also kind of like, managed to drag in professional services and like data providers, like RELX and even Thomson Reuters. The market seems to be saying that, very popular industry standard products, which are very widely used and, are actually growing quicker now because they've incorporated AI. Those will basically disappear overnight. So again, there appears to be, sell-off there appears to be kind of like overkill.
And just to point out, Thomson Reuters is the parent company of Reuters Breakingviews. I was going to hop in here, Jonathan, just because I wrote a piece about consultants. So think of the likes of like Accenture. And it was after a meeting I had with a finance director who was explaining that what they do is they get these companies like Accenture to do like outsourcing stuff for them. And they pay them a certain amount that's cheaper than what they would pay to do it in-house. And then they started using AI. So these companies started using AI internally and started to see how cheap it was. So they went back to the Accentures of the world and said, you know something, we've been doing this in-house. This is how much we think it costs. So we're going to pay you like 10% of what we've been paying you before. And that obviously is a big hit. So Prana, for your categories, does that affect all of them? That sort of notion that AI can do all of these different things, as Jonathan said, like a little bits of things that they can do, but actually adds up to quite a lot?
Yeah, it's there's bits of their businesses that are impacted, and even with the consultants like you mentioned, like say the Accentures of the world, even though there's parts of their businesses where they might be doing things like software testing or development. Those are things that AI is like really good at, and companies can kind of do themselves. But there's a part of integrating AI into a company or how a company works in their day-to-day operations, like automating stuff. And there, the rules of how, data should flow kind of like changes from company to company. And there you kind of still might need, the consultants to kind of like keep tweaking how, the AI works. So there might still be something there for the consulting type firms to pick up.
And I'm curious, Neil, maybe it's worth pulling you in here because I'm trying to pass through what the sell-off means in terms of implications for these companies and also, kind of on both sides of the cap structure here, right? Because a lot of these folks, you have, plenty of listed companies, but also a bunch of companies that were starting up in this software as a service model, SaaS, right? Which is you have steady subscriptions, customers sign up again year after year after year. And the assumption is even if you are not profitable right now, if you are acquired by some buyout baron and they decide, okay, we just need to flip the toggle, they can cut all of their spending for growth. The subscriptions will stay put at least for a while, and that just becomes cash flow. That was a pretty sacrosanct assumption in the middle of the private credit industry, right?
Sure. Well, it was, the boom in software buyouts is really one that has depended on the growth or come hand in hand with the growth in private credit. In the last few years, and the sector's grown to sort of roughly $2 trillion size, and there are some numbers out there that something like a quarter, somewhere between a quarter and a third of the market are basically software buyouts. And so obviously, if you see the kind of destruction in value in the public markets, where you see EV/EBITDA multiples collapse in the course of the last year or so, when you feed that through to the private market, that clearly, given that these companies are much more indebted, the question then becomes, do you start to see a loss of value on the debt. That if your company is no longer, if the average multiple has gone down below 10 times EBITDA and your starting point is sort of 8 times EBITDA debt, then clearly the equity is much less valuable and the debt starts to look at risk.
So, Neil, what have we seen in terms of that so far? Is that yet to come?
Sure.
Or
Right. Well, so far, there have been actually a couple of restructurings within the private credit land of software type companies. But in terms of the sell-off that we've seen in the last few months, we don't really know the effect of that on the private market because private credit is not marked to market daily. There aren't public marks that we can see. However, we are seeing stress building in the public debt markets, particularly the public loan markets, or I call public, but what I mean is the more widely traded loan markets. And there, something like 30% of the loans that are deemed to be distressed are in the software sector, which is roughly twice the proportion of public loans that are in the software sector. So that gives you a sense. I think the sort of the volume of distressed loans, one of the data providers was saying, has gone up to 25 billion from about 10 billion at the end of December. So you can see a certain level of stress they're building in the traded market, and clearly that will have an implication for the private market too.
Right. And you took a look at the pairing of this because, like you say, the private credit is not marked, but there is a way for people to express an opinion on those portfolios, right? Which is the business development companies, which are these listed vehicles that a private credit manager will set up. They do an offering of equity, they get some capital in, they begin going out and making loans. And those are a way to express an opinion on private credit, right? And I think you kind of wrote a piece, Neil, talking about how there's, I guess, a BDC apocalypse to go alongside the SaaS apocalypse.
Okay. Right. So you do have the listed business development companies, as you say, Jonathan, which are publicly traded vehicles, and where you can see where they trade at a discount to the value of their assets. That is clearly the market signaling some level of distress. Then there's also a whole other kind of fund called the unlisted business development company. And these are companies where people can actually withdraw their money every quarter. They can take out about 5%. And so the concern then is that people start to worry about the valuations on the loans in these companies, try to withdraw their money, and then those funds are unable to provide the cash that people want, and they have to shut off redemptions. I have to say that's not what we're seeing just yet. There have been a couple of unlisted BDCs. Well, there's been one unlisted BDC that's had redemptions of 15% last year, and it's so far managed to honor those. But so this is really a sort of a tail risk scenario that we're talking about.
Right. And it's interesting because the unlisted BDCs are sort of where the action has been in recent years. This was a way to get into the wealth channel, as the big buyout shops call it, e.g. getting fairly rich individual investors to kind of plop some money into one of your products. And those have produced incredible fees for the likes of Blackstone and whatnot. And Blackstone's B-Cred is, I think, something over $80 billion in kind of like gross loan book. Yeah, so these are very, very big. What I want to do is maybe drill down on one specific piece of it, because I referred earlier to this idea that, you had this sacrosanct notion at the core of private equity buyouts in software, which was subscriptions are sticky and that they give you a floor for cash flow if you need to just kind of cut back and hollow out the rest of the company. And Pranav, I know you've been looking a bit at some loans that were made on that basis, right? Do you maybe want to explain a little bit kind of how that works and what the potential risks are there?
Sure. Jonathan, these are essentially ARR loans, or recurring revenue loans. And the metric ARR, which is like annualized, recurring revenue, is really important for the software, sector, because it's the best representation of the most recent financial health of a software company. Because last 12-month revenue can kind of misrepresent a business that's growing too quickly, or not growing as much. So you can have both. What software buyout deals involved was, instead of borrowing from direct lenders as a multiple of EBITDA, these loans were structured as a multiple of ARR, and 1.5, 2, and in the heady days of the pandemic, this went up to 4 times ARR. And the say 3 years into that loan, that would kind of like switch to an EBITDA multiple. The assumption there was that between the direct lender and the equity sponsor of the private equity company was that the private equity ownership would be able to kind of like cut out a lot of the excess costs, and therefore that kind of lending would still be viable. So that's really how that worked, and now
Right, and
that's, I
I'm
think, come under
presuming
some
now
stress.
the big fear that everybody has is that revenue is not actually going to be as recurring as was previously thought. Like, companies that had retention margins that were over 100%, e.g. indicating that not only did they keep all of their customers, they signed up for even, new services or price hikes in the new year. That might start dipping because a bunch of them are going to realize, like, wait, why am I paying for 20 different subscriptions right now when I can get Claude to do something, right?
Yeah, I think it's like it's a slightly nuanced thing, Jonathan, because ARR loans, as a kind of category of lending, for these kinds of buyouts may still survive because they've kind of been tested by a rate of high interest rate cycle. But what's really unknown is if a private equity firm does take on like an ARR loan, through a buyout, and technology or AI technology kind of like makes that company's business almost irrelevant, then that risk is like very hard to estimate. So equity sponsors are now saying that they're really only picking high quality businesses and like very sticky ones where what they call, the jargon they use is deterministic workflow, where if you want to look up last quarter sales, you only have like one figure, and like that's not something that generative AI can like disrupt. Really, software businesses that are like very, very important to clients operations, those are the firms that are kind of like being narrowly targeted with these ARR loans now.
Jonathan and Neil, I'm sort of curious because, Jonathan, I think you really set this up really nicely about this idea about the same people who are funding the AI companies are also funding the companies that are are getting in trouble because of what AI is doing. How do you see that playing out in terms of if they're, let's say, one of the companies that is providing these software services comes into trouble? How would that then impact their ability to fund all of the other things that they're trying to do with the big AI companies? I'm just sort of curious how that like link is there, or is it? Are they separate? Jonathan, I'm going to ask you that because I think you brought it up.
Sure. It's interesting because you look at somebody who's sort of in the worst of the damned if you do, damned if you don't position, right? And you would kind of come out to something like Blue Owl Capital. So Blue Owl Capital is, you think about their AUM, this is an oversimplification, but call it roughly a third. A third was in these direct loans, and some of those, as an overall percentage of the portfolio, it might be a kind of low number, but it concentrated in a few funds. There was some pretty high exposure to software. And then another third of the company is really back in this like data center, real assets build out. Blue Owl did this gigantic deal with Meta Platforms to build their Hyperion data center that was like 25 billion plus or something like that kind of deal. And so you think about it as, if everybody just has generalized overheating fears, and then you layer on top of that the AI thing, it's a bit difficult because you think, okay, you can't really coherently hold those two ideas at the same time. Maybe you could if it's sort of like, AI is super disruptive, but actually the supply side of it, e.g. the cost of running all these queries through the chips and whatnot, is just totally hopeless. And so what these companies are going to do is just like burn themselves and the people they're replacing down to the ground before the whole thing collapses. Like, that's sort of an idea you can hold in your head. I don't know the degree to which I buy it necessarily. The rate of improvement for these models is like very, very rapid at this point. We'll see how it happens. But you see how like a Blue Owl basically gets trapped into a corner there by investor sentiment, and you've seen them kind of drop a lot. And again, I think the steel man of how bad could that get is you look at the two listed BDCs that Blue Owl runs, which are trading at decently chunky discounts now, as Neil mentioned, and you look at their filings and you look at the management fees that they're paying out and you look at the incentive fees that they're paying out, that's a pretty decent amount of Blue Owl Capital, the parent's overall fee stream. And so you can make a winning bet on the AI side, but if it's something that's going to be hurting what has been your previously, let's call it the last gen of the buyout baron game, where everybody was setting up these kind of vehicles to ensure these big, steady, stable, chunky fee streams, that could be hurt by it. So you look at the numbers and there is a way to make all these stories make sense, even if they're putting winning bets down on some positions. I don't know if, Neil, you have a different view on that.
I don't, but I guess the key question then is whether you need as many data centers if Anthropic is already delivering the kind of disruption that we're seeing in the SaaS sector. Is the data center build out such a powerful hedge to that? Maybe it's not either.
Right, and that's really the grand question overall, right, which is kind of unknowable here, which is what will that rate of improvement be? What will the rate of efficiency improvement be? And are you going to have a bunch of stranded capital behind assets that really just don't end up being that useful? And I think right now we are totally not in a position to be able to answer that. I think there is reasonable cause for skepticism. There is reasonable cause for optimism. It's a difficult one, and when there's so much capital flooding in, I think history teaches you that maybe you should just be a bit cautious. But for now, I think all we can do is really wait to see what happens. And on that note, let's wrap it up here. Neil, Pranav, thank you so much for joining us.
Thanks.
Thanks, Jonathan.
Thanks for tuning in. This podcast was produced by Cheryl Pena in New York and Gregory Garner in Toronto. You can listen to a new episode of The Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune in to our sister podcast, The Big View, every Tuesday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow The Viewsroom and let us know what you thought. We have a new email address where you can send feedback, which is breakingviews-podcasts@tr.com. And check out our views on the biggest stories in business and finance every day on breakingviews.com and on reuters.com.